Hello, fools. We are so excited to spend the next, 45 minutes or so with the CEO of Skyward Specialty Insurance Group, ticker symbol SKWD on the NASDAQ. Market cap is about $2 billion. It is a two-time recommendation, a three-time recommendation in our small cap services and in our Moneyball portfolio, which we'll tell you about that in a second, Andrew. But basically, we have, through AI-powered system, scored every public company across a number of factors, and Skyward Specialty Insurance scores pretty well, and that's how we found your business to begin with. So we're so excited to be able to spend this time with you. We've got a couple fools here to interview you, and I think I'll just start with the first question, which is, can you just explain what your business is to somebody who loves business but knows nothing about insurance?
All right. Well, probably in the insurance world, you can sort of broadly break it into life insurance and property and casualty. Most people are familiar with property and casualty at a minimum through buying homeowners or car insurance coverage. We don't do any of that. We are solely focused on commercial insurance, and as a company, we're really focused on areas of commercial insurance that are particularly unique, difficult, hard to place, dislocated, things that we call specialty, and generally there are places where broad market participants are not present. You have to have real expertise, to be able to serve these categories in understanding kind of the risk, how to create product that is useful to the folks who are looking to transfer risk, and we perform a really powerful service because many of the categories that we support are really interesting parts of the global GDP, and so and the fact that we're doing things that are specialized in nature than many other companies, many companies that are even more familiar to some of your folks that follow you would know is really what makes us a really interesting business.
Yep, that sounds great, and you've had a wonderful track record, and I think specialty insurers in general, have done very well as of late. We've seen some of the larger players pull back, the AIGs of the world, and that kind of stuff, and you're one of those companies that has filled that niche very well. I know we're going to get into a big acquisition that was very recently announced, but before we do that, maybe you could kind of just give us your state of the specialty insurance market, how things look today and what you're thinking about in the next maybe 3 years going forward.
Yeah, listen, I think the really interesting thing about specialty insurance is that there is no one defining sort of here's how the market is performing. Geeks around insurance like me oftentimes will talk about hard markets or soft markets. That's generally a statement about what the pricing environment is like. Hard markets being that pricing is favorable. Soft markets are unfavorable. We're an industry that generally goes in pretty big cycles. Too much capacity leads to soft market. Then you have industry events, natural catastrophes, sometimes even liability-related events, and the market gets very hard. The really interesting thing about specialty insurance is it's really like a bunch of very unique segments. And I would argue that they're really like microcycles, that almost every one of the businesses that we're in can't sort of be easily put into here's what's happening in the property and casualty industry. And without sort of talking up our business too much, I think one of the things that we've done really well is we have a really interesting, very thoughtfully and intentionally diversified business portfolio. And so that allows us to put our capital to work at different places at different points in time, based on how attractive the market is. And I think that many of the other specialty insurers that at least we would hold in high regard, have at least some dimension of similar portfolio sort of diversification that gives them, the ability similarly to redeploy. And so that I think is one of the really interesting sort of features of, the better to best specialty insurance companies in the marketplace.
Yep.
Well, Andrew, yeah, we talk up your business as much. That's what we're here for. So we'd love to have you here talk about that. Maybe just talk about some of those verticals: the accident and health, the ag, how are they evolving right now? Piggybacking on Buck's question about the market in general, which of the verticals are you seeing? How are the cycles going in those verticals today?
Yeah, well, let me just say that broadly speaking, the property market, which only 18 months ago probably was at an all-time commercial property was probably at an all-time most attractive place from a profitability perspective over my 30-plus year career. I mean, really was very attractive. Has become in aggregate a quite soft price market in a very short period of time. And I think off of very attractive pricing levels. So, we're probably not at a place where things are unattractive, but we might be moving there pretty quickly. On the flip side, casualty, which is liability insurance, kind of broadly, there is a very large portion of the U.S. market that is it's really tied to things that are personal injury, bodily injury related. And we are in a period of time where the cost of inflation, principally driven by social inflation. So think about what a person who's injured might be compensated for that injury, or persons that has been inflating at a rate that is just it's not economic. There's a whole bunch of sort of things that are going on behind that. Not the least of which is sort of the strength of the plaintiff bar. Litigation financing. I think you have a wealth gap that is created. If you ever up in a jury situation, you have sort of a view on sort of a disposition towards corporations that is all playing into this. And so the casualty market has been actually a very attractive pricing environment, but that's largely trying to just keep up with inflation, and that in itself is not particularly attractive. So that you highlighted a couple places in our business where things are super, super interesting. So accident and health is a place where we write a product that's a medical stop loss product. So many companies in the United States effectively self-insure, and then they buy a coverage, should losses get to a particular level. And we focus on kind of the small employers in providing that medical stop loss coverage. We are doing a lot of really interesting things around medical cost management, and we are doing quite a bit both in the medical cost management and the underwriting side using AI and predictive analytics to really be able to do things that many others have not even thought about. And it shows in our results. We recently read an industry report that took the statutory results for our industry, and our loss ratios are a full 25% better than the three largest writers because they're writing large market stuff. We're writing small market stuff with these really interesting propositions. And another thing that we notice is that we're 15 points better than the market overall. So clearly, while the market in itself may be moderately attractive, our returns in the market are legitimately distinctive. Amongst the 50 largest writers, we were amongst the top 5. And so clearly we're doing things in the way that we're approaching the market using advanced technology. Agriculture is another really interesting business. We are focused on providing solutions only into markets where the government is providing some subsidization. Those are the markets that have structure that allow a company like ours to be able to find ways to provide product that's really interesting and profitable. And one of those that's really been very successful for us is here in the United States. There's a program focused on price protections for dairy and livestock producers, and we've generated a one-of-a-kind product to that marketplace that has been a big contributor to our growth and our earnings. And so when I talk about specialty businesses, now you can get a sense like we're really honing in on very specific places that we think that we can understand the features of exposure and risk transfer and build a product that's attractive to the marketplace that allows us to earn a super return on our capital. And those are two great examples that have really kind of shown through in our results over the course of the last handful of quarters.
Awesome. Thank you.
Well, since we're talking about the AI and analytics and stuff, I will jump right in. And well, first, I guess just a general question, since you started talking about it, Andrew, could you explain just in general words what's the Skyward overall strategy around AI, especially now when many companies are transforming using AI and generative AI, and what's Skyward relying on?
Yeah, so I would kind of break it into old and new. I think like many, AI to us meant maybe more traditional machine learning. We have examples of using predictive models in risk selection, in guiding us on the way that we might handle a claim. And some of that stuff was just, traditional machine learning models, Bayesian stuff, things that were prior generation. Like I think anybody who's really kind of being thoughtful about what's happening in the environment, we're leaning into, the natural language model, GPTs that are publicly available. And my answer to you is I think that it's evolving, right? Because things are happening at such an amazing speed. I think what's unique is prior to joining Skyward, I spent 4 years as a partner in venture capital, and then I ended up leading a technology company that we had invested in. And so I'm kind of like one of these unique people who's an insurance guy who has spent time in the world of advanced technology. And so to me, we're leaning hard into it as a result. I think the most sort of substantive thing that I could describe to you is our idea of a bionic underwriter. And I'm definitely dating myself by referencing bionics. People will immediately, from my generation, will think of the bionic man. That's actually how we think about it, that the world that we operate in is really hard to understand how to evaluate a risk that you might want to offer coverage for. And the way I would describe it is that if you use an American football analogy, a traditional underwriter, would start on their own 25-yard line, their first offensive play after a touchback. And what we're doing is we're using AI to run back to the opponent's 20-yard line before the first offensive play is run. And so what does that mean? We might receive a submission for a risk that could be 10, 20, even 100 pages, very complex information about the company, about its exposure, its loss history, things that you want to know. And we are using AI to ingest all that information, to be able to structure it so that our core systems, including pricing, is able to get that information nearly in a zero human intervened way, to be able to provide a robust narrative to our underwriters so that instead of pouring through complex risks, they're seeing a dashboard of that risk along key vectors of things that they would want to evaluate that risk on. And then, of course, there's a world of third-party data out there. So, if you are writing something in the healthcare professional liability world, there's huge amounts of databases around, state sort of information about the performance of every doctor and their licensure and so forth. So there's all this information that you can leverage and bring into some kind of risk scoring that really changes how it is that your underwriters, which is where our money is made, engage with the opportunity, with the risk. And I will say that GPTs and natural language models are fundamentally changing that in a way that we think about our underwriter as a bionic underwriter. And we also believe that we're ahead of many in where we are in this journey. And so, hopefully that early learning curve will continue to sort of inure to our benefit as we continue to figure this out.
Just a follow-up question, and you already started to anticipate it. I was wondering how your niche specialization works here. Do you, for instance, have problems with enough data in particular domain, especially for the not for generative AI, for instance, that can analyze currently pretty much everything, but for normal machine learning models, if you use them, because specific data sets, I guess, could be or difficult to construct or difficult to find. Do you have your own data? Do you rely on third companies?
Yeah,
And in general,
it's a great question. I actually think that this is one of the beauties of our business because we are really so niche focused. In fact, for folks who follow us, we call our strategy "rule your niche," right? And one of the powers of this is that these are oftentimes such specialized markets that traditional scale, so names that you might think about as very excellent insurance companies, Travelers or Chubb or others, they don't necessarily have an information advantage over a company like us. I think innovation, and there's a few things that allow us to sort of leapfrog ahead. One is just the expertise of our people, right? We're operating in categories where we have deep experts in those categories, and part of what you need to do is make sure that you're getting all their expertise. Okay, well, how are we doing that? We're taking things like our underwriting guidelines. We're taking the actual business that we quoted and we lost, or quoted and we won, and we're using that actually to train models. This is the power of the GPT and the natural language models that we're working with, is that not everything needs to be structured in such a way that that you have all of your rules codified. You actually can take, here's the business that we were interested in writing, here's the business we were interested in writing and we won, and start to build sort of the cognitive reasoning behind that. And so I think that that's a really interesting feature. I also would say that there are AI models, and I'm outside of my area's expertise, but there's a lot of very interesting developments in terms of boosting techniques that can take small data sets and bring greater confidence to them. And of course, when you're dealing with such niche markets as we are, those are things that we're leaning hard into. So I'd like to sort of characterize it as this is cases where the lack of sort of real heavy industry data probably works to our advantage, and maybe the economies of scale that others have don't necessarily show up as to nearly a great extent as they might in other areas of the insurance industry.
Can you talk just a little bit as we will move from technology to your financial performance? Can you talk about AI within your culture?
Yeah.
How are you? Obviously, every company is approaching this with similar challenges, but in different ways. We see some of the largest technology companies, some of the largest companies in human history, with literally tens of billions of dollars of annual cash flow going through layoffs. That is not something, looking back over the last 30, 40 years, that you would normally see. You would see layoffs at a large auto company that's going through, a tough turn in the economic cycle. But you're seeing the highest performing companies in history laying off, 7% of their workforce in 6 weeks.
Yeah.
So something is changing in employment, how we work, what skills are being valued and which ones are losing value at a pace that we've never seen before. So what's happening inside of Skyward with regard to deployment of AI and evaluation of skill sets and moving your whole workforce forward?
Yeah, well, it's interesting. I have the good fortune of having my son is actually in the technology industry, working at a venture capital backed fintech, and we talk about this all the time about as an example, what AI is doing to software engineering, right? And he himself is an engineer. So I do actually have great appreciation for the question. Look, I think that for us, the kind of things that we do from a knowledge, a technical perspective, underwriting, claims, much of this is really about sort of talent and technology. I think that technology can bring us a meaningful way there, but not necessarily take all the experience. And by the way, our business is still a human interaction business. The elements of human interaction that are really important that apply to judgment, and replace that. we are fortunate that we have been a consistently strong growing company. And so that in itself sort of is a backdrop that, at least in comparison to broadly the financial services sector, certainly to P&C, we're definitely outgrowing the market by a meaningful multiple. And so I think that we have more needs, more demands, more opportunities. I will say, though, that in the end, ultimately, I would characterize AI as being the leverage for growth as opposed to the leverage for cost reduction. So the bionic underwriter, to use that one part of our business, maybe in one category, our underwriters will be responsible for $5 million of business. And, we're looking at the way that we want to deploy AI as the ability to for an underwriter to be able to manage a $10 million portfolio. And for us, that goes correspondingly with AI is allowing us to respond to opportunities quicker. It's allowing us to be more precise about the things that we want, more precise in terms of the pricing. So it should be an engine for growth that actually goes sort of hand in hand with the efficiency. And that's been the case for us so far, right? We're, just to put it in context, I came in 5 years ago. We had 375 employees, excluding the transaction that we announced a few weeks back. We're 650 employees. We added 100 new employees last year. So I feel like we're still a place that can always use talent and deploy them profitably for our business. I am going to give you one real example that I think stands out as unique in the world of sort of tired old insurance. So in 2023, when GPTs first came sort of into the business world and people are like, what is this? We use OKRs, which is a technology sort of driven approach to setting goals and cascading that into the organization. And so one of the OKRs that we set out, this is 2 full years ago, is that we brought in OpenAI's GPT engine behind our firewall, took all the public training, added to it our own information, and we challenged every single employee to build at least one use case for their job about where it is that we could use a GPT to improve the performance of their job. So in 2023, we had 500 plus employees who were already experimenting with this. If you don't believe that's a huge advantage for a company like us to have that kind of capillarity and understanding and experience 2 years on now, that's huge. And so when you ask the question about how we're doing it, it's crazed and frantic and not the most organized thing, but boy, the awareness, the understanding of our people and the ambition to do things with this, it's not run from it, let's be frightened of it, but let's embrace it and make it part of why it is that we're going to compete and win.
Yep. And that's such a great mindset. I've followed insurers for over 20 years now. And I'd say when technology, let's say around 2000 or so, when the internet came, of age and all this kind of stuff, a lot of the technology companies, like you said, pretty stodgy, pretty skeptical of technology. And I think, there's 2 times to invest in technology, too early or too late. I'll take the first one. And I think some of those companies that, particularly in insurance, they were like, we'll take a wait and see approach. Now they're kind of paying the price a little bit for that. And so I'd like to talk about, switch gears a little bit, but it's still related to technology for sure. You mentioned Apollo, which is the big acquisition that you all announced. I mean, this is a large one. And I'd say, I'll be honest, our first inclination, I think generally at the Fool among our analysts, is like big acquisitions are hard, big acquisitions are harder. And so it's a pretty big one for you guys. I like it strategically. Can you just give us a little bit of thought strategically behind it? I think it's about a $555 million deal. About 2/3 of that is going to be cash, and then 2/3 will be stock. But just talk about the strategic fit. And then I'd also like to hear a little bit about you're a technology company. They were as well, Capital Light. How about the integration of technology between those 2 companies? Because that's something I'm interested to hear about as well.
Yeah. So let me just say that for anybody who's listening, we take the seriousness of a transaction as any investor would, in terms of be cynical. There's risk involved. And I don't want this to be sort of interpreted the wrong way, but one of the powers here is that I was personally the architect of a similarly large acquisition in my role at Hanover that is viewed generally as one of the most successful acquisitions of a Lloyd's of London company by a U.S. property and casualty carrier, and that was at Hanover and an acquisition of Chaucer. So there's a playbook, that I bring and my team brings that we feel very confident in. That said, look, I think that what makes this so darn attractive is that we have been working for 2 years with Apollo, and you could not find two organizations that are better matched in terms of their culture and their ethos and their orientation about how we're going to compete and win. And it really kind of went to a very high bar based on the sort of the similarities of how we think and approach business. So that's one dimension. To your point, we are a traditional full stack insurer. Basically, except for some use of reinsurance, every dollar of risk that we write, we keep on our balance sheet. Apollo is incredibly attractive. They do have a capital light model where some of the risk is compensated through fees, and unsurprisingly, investors certainly like that, and there's tremendous optionality that they bring. The thing that I love the most, like off the charts the most, is that a big chunk of their business is focused on really interesting growth sectors, and so areas of the sharing economy, autonomy, and their whole model is, instead of like a traditional insurance product, here is an insurance product that we are selling you, they're much more sort of partnering with their customers, working with data related to exposure, and as a result of that are crafting product and giving insights about how product can be structured or risk management can be structured to be able to eliminate potential loss. And it's a very data science led approach that I've never in my career seen anything like this. And they're a fantastic performer and very interesting in this approach, and in categories that are innately far higher growth than sort of a cross section of the global or the US GDP. And in that, we basically have brought into our portfolio a company that's one of one in terms of its capabilities. It is. I'm smiling because I am so excited about the future. I really am. And right before this call, I was on the phone with my Apollo colleagues, and the opportunities are almost limitless. I couldn't be more excited. I think we have something in this partnership that really no other company in the industry anywhere has, and that's an exciting place to be for me, and certainly my colleagues as well.
Andrew, can you just so this is Apollo operates inside the Lloyd's of London market.
Yep.
So maybe just 30 seconds quickly on the Lloyd's of London market, why it's unique. And then my follow-up is it manages two syndicates, 1971, 1969. 70, they are different. These are two different syndicates. 71 seems to be a little bit more exciting than 69, but I think both have a place, and talked about the difference there and what your expectations are for those two syndicates inside the Skyward family.
Yeah, so you're right on that observation. Going back to Lloyd's, Lloyd's is effectively where insurance started. Lloyd's Coffee House, and effectively insuring ships, and the idea of names, which you might have heard of, or people writing their names and providing a portion of the coverage. That concept is the foundation of Lloyd's. It is risk that it's always specialized. If it gets to Lloyd's, it's specialized. It is oftentimes very large limits or high capacity, so it's syndicated risk, meaning multiple parties will take a portion of the risk. Inevitably, though, the folks who lead the underwriting are experts in those areas, right? So you lead with expertise, and then market basically supports that expertise. And that's the structure of Lloyd's. There is a mutuality to it that provides it a very high level of credit rating. So it's an S&P A+ rated entity. Similarly, it's an A+ rated AM Best, which is important for insurance entity. And as a member of Lloyd's, you have the benefits of those ratings. You write on Lloyd's paper. and so there's benefits that inure to you. You're right, and specifically talking about Apollo 1969 and 1971. By the way, Apollo and the numbers are all connected, obviously, to the missions that were principally under Neil Armstrong, who actually was an initial investor in the business. 1969, I would describe as a true, maybe more traditional Lloyd's specialty business. There are certain things that are written in Lloyd's that are not oftentimes written elsewhere. A great example of that is political violence, right? Political violence is the expertise that is there is unique, and so much of the political violence kind of risk is written out of Lloyd's. And so those are things that we would not have been able to access. They're complementary to us. I would describe that as kind of a Lloyd's, 1969 is a Lloyd's specialty business. And then 1971 is this other business that I was just referencing. It's called iBot. It's focused on principally U.S. businesses, not entirely, and it is focused on new economy businesses. So think about all the things tied to the sharing economy. I mentioned autonomy as an example. So you think about today there's a whole cadre of robotaxi entities that are emerging. The most notable probably to people is Waymo. That whole domain of autonomy, whether it's moving people, whether it's moving goods, is going to be a boon area for global GDP, and it's going to be a boon area for the insurance industry. They are so far out in front of having expertise, unique data sets, and serving that market. That's the part that I would say to you that's really unique, that is additive to anything that we could ever see through any other possible combination with another company.
And as you mentioned, only about 5% overlap between what Skyward had done and Apollo. So that's certainly a really nice strategic fit. On the technology front, one thing that I've seen with some companies over the years is they acquire different companies and new technology systems, and they start stacking on top of each other, and then kind of at some point maintenance costs start to catch up with them. From a tech standpoint, what happens here from the integration? Like, what do you think as far as like what are the big points, and are you guys running different systems? How does that stuff work? Are they on a different claim system? All that stuff.
Yeah, just to be clear, I would describe this as two divisions of an entity that will only share technology where it makes sense, as opposed to trying to sort of harmonize.
Right.
I spent 20 years in strategy consulting, and I have a very kind of pragmatic and also a huge amount of scar tissue, from lots of experience of that over many years. I think each of our companies are really well situated. In our case, what we've done is we've basically created the really thin layer, the window for our underwriters, the window for our claims people into how they operate, and we've shielded them from anything in the back end. There's been this discussion of kind of like the API-ification of the insurance industry. We're at the front end of that. Our ability to sort of turn on, if we want to turn on new information that we can get about a particular area of risk, or we want to turn on a new predictive analytics engine, our ability to do that and integrate that into that window pane that our underwriters experience, or our claims people experience, is a really low cost, very fast process for us. And similarly, Apollo has been on a similar journey. So I think, listen, there's always going to be another generation of new technology, right? And that next generation is probably not going to be written by people. But for where we stand right now, I really like our position. We are not restricted by the last generation of big iron. We control the interfaces that the key functional areas of our organizations operate through, which means we're not reliant on some external vendor, with a vertically integrated ERM system as the means for us to be able to deploy new things. And I think in that regard, speed wins in this case as opposed to speed kills, and I think we're pretty good on the speed front.
Okay, thank you.
Andrew, I found it interesting. I can understand why Skyward would be so interested in Apollo. It's bringing in $1.5 billion of managed premiums. you laid out how profitable, especially iBot is 71, but 69 too relative to the rest of the world, relative to the rest of the Lloyd's market. I am curious about what Apollo saw when you all first started talking about this. You know, what do they get now being part
kind
of
of
the
insulting,
Skyward
Andy.
family?
It's kind of an insulting
that's
question
okay.
you're asking.
No, it's a very real question because it'll be
Force
very
them to
interesting
reopen negotiations now.
Yeah. The good news is
I mean,
you
you
can't
gotta
do
very-
that in the
yes.
UK at this point.
Yes, exactly.
Hey, listen, Andy, I'm not insulted. Tom, I'm not insulted at all. I've been asked this question. I've been asked this question because some of our most knowledgeable insurance industry investors, you know, people who are really focused on the category, did a bunch of market checks and were not only surprised, I think they were surprised the fact that we had it on a sole source basis, and even surprised by the value that we ultimately paid against how the market perceived Apollo might trade if they ran a process. And so, look, there are really sort of three key things. One is we'd spent 2 years building a relationship, and I'd like to think that we're a really attractive partner to them, and I think they would say as much. They saw in us like-minded folks who potentially could meaningfully help their business get to the next level. And so, you know, I think there was just a good fit culturally and in terms of the industrial logic. The second thing is that they had about 50% of the businesses. It was owned by, or is owned by Alchemy, a private equity firm out of the UK, and I think that, you know, we kind of found what I'd say was the clearing value, and then ultimately it came down to, you know, we were clearly an organization that was capable of executing this, and you know, sometimes it's, you know, you have an opportunity now, probably at an earlier point that otherwise they would have exited. You know, I'm not going to say whether the value is less than they would ultimately have wanted if they went on a normal cycle, but you know, I think we preempted that in a way that was acceptable for them and worked for us. And so I think that's the second item. You know, and then the third item, you know, is that it wasn't too hard for us to see things that what we could bring to them they could not do on their own, right? So the most simple example of that is if you're a Lloyd's business, you're using Lloyd's paper, and Lloyd's paper gives you the ability to write risk all over the world because of their licensing. But the business has to come into Lloyd's, and that's a relatively expensive thing. iBot, much of the business is U.S. business, and quite honestly, the nature of how they approach it means they should be closer to the ultimate buyer of insurance. Think, you know, large technology companies. And we enable them to do that. We have statutory entities that allow them to conduct that business closer to the source. And in that is just one small example of things that together we looked at and we're like, wow, that's really powerful. And I'll just note for you that I do think that the sellers, we took out the private equity guys, cashed them out. The employees and management, they're rolling 40% of their equity, and of course, you know, we're also incenting them with additional equity. And I'd like to think that well, first off, I think we're hugely undervalued, so I think that they might have seen that as well, despite, you know, what's been a strong run in our share price since we went public. I think that they believe that the power of sort of our public shares, the liquidity. And importantly, I think the value that we can create together just was an attractive proposition, and the alignment. We're all in this together. I'm a huge investor, a huge owner in the company. We're all in this together. We're going to win and lose together, and I think that they really liked that feature. You know, there's a point in time where maybe a company says, "Do I want to be private? Do I not want to be private?" And if you're private, that means private equity, and it brings with it a wonderful set of things, but it also brings with it a set of demands. And I think in this instance, management concluded that as being a public company with Skyward, that we have a tremendous value creation platform for us and for our investors.
Oh, what a great answer.
Thanks.
And what a
Thanks.
great question. I am putting us dangerously at risk of ruining this entire conversation with what I'm about to do. But we're going to take that risk together unless you opt out. Here we go. I'm going to screen share, and we're going to go hopefully rapidly through this. You can opt out
goodness.
of the game. Yeah, you got it.
I'm
Here
putting on
comes
my
the
glasses.
Okay, so we're just going to rapidly go through financial statements, and you just tell us one thing that you find interesting. Again, we're out here as Motley Fool investors. We have a lot of people with expertise in different industries, but when they come to a company like Skyward, they may not have any idea how to read the financial statements.
Right.
You don't have, given the time that we have, I don't want to take too much of your time. You could just pull one thing on the balance sheet, one thing on the income statement, one thing on the cash flow statement that are just interesting or useful to pay attention to in order to understand Skyward.
Okay. Well, listen, I think that probably the most interesting thing just on this is the largest item, our invested assets. We're in the business of taking insurance risk, not investment risk. And so today, we have north of 85% of our invested assets in very high quality fixed income and cash. Our embedded yield on that is 5.3%, which is pretty good. And yet we still, even probably in a downward yield environment, downward interest rate environment, because of what's rolling off, we probably still have some juice here to continue to increase the investment yields in our business. And it's a really good portfolio. So, in that regard, we have what I would describe as a really clean investment portfolio with the ability, as the interest rate environment comes down, for us to think more creatively about how it is that we deploy our investments, going forward. And so I think that's probably the highlight on the balance sheet.
Excellent. Thank you very much for that. Okay, here we come to. Oh,
Can I do a quick follow-up on that?
Yes.
Yeah, please.
You said most of it's in fixed income. The average duration, is that pretty short, I would imagine?
It is. The average duration is just a little over 4 years, and we're kind of staying there. Our average liability duration as a company, meaning the sort of the average time in which claims are fully paid, is about 3 years, which is a relatively short duration. And we just, this is not the time to go on the long end of the curve for us. You're not getting paid for it, and so we kind of like where we've been, and we've been staying there. So.
Yep.
Excellent. On to the income statement.
Oh my God! Well, listen. I mean, we generate a lot of income. I think that's probably, that. And if you take income and you divide it by equity, I would say that listen, we're a high ROE business, high teens ROE business. And low volatility, which is really unusual for an insurance company, because I think one thing I would just highlight for you is that a lot of companies are writing property cat, which means that your earnings might go up and down, and you oftentimes are carrying a lot of capital, whereas we're not writing long duration liabilities that have unknown outcomes, and yet we're a low volatility business. So a company that's producing the kind of returns given our capital and low volatility, that's a really interesting combination. So I'd combine this with the prior page, and I'd also point out that you also have to look at the growth number, right? The growth number is really important because when you add high growth, very attractive returns, low volatility, pretty hard to find companies that have that profile.
Mm-hmm. Excellent. Thank you for that. And now we go finally to the cash flow statement.
Okay, I'm just gonna bypass the specifics of this statement and just say that we have, because of our really great underwriting and our growth, we've been generating a huge amount of cash, which is translated to a far larger invested asset base, which of course then generates returns that go to our income statement. Today, roughly 50% of our earnings come from cash that's invested on the, cash from operations, and we are generating a lot of cash. We've been generating a lot of cash for a long period of time. I mean, just to put this in context for you, for every dollar of premium that's earned, right, sort of our revenue, our key revenue item, for the last couple of years, on average, paid claims out the door has been less than 70 cents. And so when you add on sort of costs and so forth, in there is an engine for cash generation that is really, really very good. And so not only are we good underwriters, what we get paid for, but we're generating cash that then is getting invested and generating very nice returns for us as well.
Thank you. And that is the first half of my attempt to ruin this interview, and I was unable to do it because you did a fantastic job going through the financial statements. Here comes the second half. I'm going to ask Anna to unmute and explain how the money. Yeah. There you go. And explain quickly how the Moneyball database is built, and then I'm going to show Skyward's numbers.
Am I allowed to point out the hallucinations in here since it's AI generated, or no?
You certainly are, but Anna's allowed to counter how we address those hallucinations. Anna, go for it.
Thanks, Tom. Yeah, basically, the Moneyball is one of the main databases that we have with all the different scores for different companies that we generate in automatic manner. So we have pipelines for specific pipelines for each one of the scores that you see here on the screen, and each score is itself a combination of several factors that we call microscores, which itself are generated by specific pipelines that get all the relevant information about the company from different sources. That could be, we rely when we can on the official sources, of course, SEC filings, but sometimes it's also internet search and other API providers, and combining all this information with different types of analysis that include both statistical analysis and just data wrangling and generative models on top. We generate the summary about this particular feature of the company and the final score. And of course, we have also on top of it different systems for evaluation, which counts both just hallucinations and in general specific aspects of our analysis, which is always fascinating also for us, because we discover more and more stuff about both our processes and different companies and the specifics of different industries, and that you cannot analyze them just putting them all together, and you need to separate everything always. And basically that's what we see. And then we have for the model also, for the final database, a super score that is in terms a combination of different scores, just a weighted sum with a specific percentage for each particular score.
Excellent. Wow. Well done. Now, thank you so much, Anna. Now we're going to go to Skyward, and the first thing that will happen is you will see scores. If you view them as 1 to 100 high school exam scores, you'll think, wow, our scores aren't very good. But actually, I'm going to tell you, because the distribution of the scores, again, this is how I found Skyward, is through our system. So now I'm going to tell you that your super score is a 73 out of 100, which actually puts you number 200 out of 3,400 companies. And it's actually harder for our small cap to score well in our system, in part because there's more data for larger companies, but also our financial scores tilt toward favoring, the dominant, stable,
I think
mega caps.
I feel like I was kind of a 73 in real absolute terms in high school, and yet still I became a CEO. So somehow I'm in a very odd way I'm connecting with this. So.
Okay, excellent. And your kids, they're going to be, I don't know if they're all through their schooling years yet. Maybe they are. But they at least can go back to their report cards and say, hey, Dad, I didn't realize that was okay. You got angry at me that year.
You're true,
okay,
thankfully.
So next few things I'll just quickly identify. The financial 5Y, 1Y score is the progression of the financial performance. And a financial 1Y of 78 puts you at number 159 out of 3,400 companies. Then when we scroll down to leadership, 89, again, another score that I look for, puts you number 83 out of 3,400 companies. And your product score has been improving over the last 5 years to 1 year. That's the trend, 5 year to 1 year. Your product score has gone from 76 to 83. Your financial score has gone from 73 to 78. Your leadership score is 89. Your super score is 73. These are all top decile and improving. Does that, I'm putting on the spot a little bit looking at numbers for the first time, but how would you explain those improvements in the scores in particular? Like, why is the product score getting better, and why is the financial score getting better in your opinion over the 5 years?
Well, look, we've only been public since January of of 2023. All right, so it's been a short duration, and by the way, we have not only been performing incredibly well on an absolute basis, but we've been improving our performance, sort of trend line, period over period over period. So that kind of fits. So I'm not entirely surprised by anything there. That not knowing kind of the relativities, that sort of the general trajectory that we've been on certainly fits very well. So I'm not surprised by that. And top decile is not bad. I was pleased in some of those things over top 3 or 4%. That's actually more interesting to me. We'll keep working.
Yes.
We can only control the inputs, and hopefully the outputs come. I also saw on the first slide that you set up, there were two other the very not this one, but the one that preceded this. There were two other companies up there, Kinsale and Palomar, that are also specialty insurance companies. Palomar probably a similarly smallish cap company. Kinsale is actually roughly the same size as us and worth 4 to 5 times our market value, and a world class company. So I'm pleased to see that, because those are very good companies for sure, and companies whose valuation forms a really powerful umbrella for which we can continue to see sort of an increase in the multiple that investors might see our companies still being attractive at.
I know that we have one or two questions about leadership culture that we want to ask, but I just want to say that this is the industry sort, right? So you see that out of 95 insurers in the database, Skyward is number 9. So, top 10% again. And then I just wanted to sort of close this long stretch of the conversation with, you mentioned, being a small cap company and getting more exposure. What is that dynamic like for you, meeting with institutions? Is that an important part of your work? Is it something that you'd rather not have to spend much time on? Do you feel like you're getting the proper attention out there at this stage, or you're still early because it's only been 2 years in the public markets? How do you think about that?
I think we had a lot of things going for us. First, we were the first IPO, post the kind of, the post-SPAC 22, desert, that first global IPO. That was pretty cool. I think it put a lot of attention on us because nobody actually knew whether, I know it sounds bigger than it is, but we did open up the IPO market officially, which was kind of cool. So we got a little bit of extra attention around that. Look, I think I love engaging with investors. I think I might not be the greatest CEO. I think I'm a pretty good public company CEO in terms of communicating our story, telling people about what's interesting and unique about us, and why I think that we're an investment that our investors should have in their portfolio. We put a lot into it, right? So if I just look back over the last 3 weeks, we've had 2 investor conferences. We had 2 visits to one of our top 5 investors. We had a dinner, hosted by one of the investment banks with a half a dozen. Next week, I'm going on the road to Montreal, Toronto, and Chicago on a non-deal roadshow. So it's a pretty big part trying to get out. And this is the season where we're pretty busy on it. I think that it's a really interesting moment because the property and casualty market is kind of beaten down. We're way off of where we've been. And yet, to your data there are probably some companies that absolutely deserve to be separated out and not necessarily kind of just pushed aside with the rest of the property and casualty market. My job right now is to make sure people understand that of course I'm selling our company and selling our story here, but boy, this is a uniquely attractive valuation for our company, and it's my job to make sure that folks understand that, folks understand how we're navigating a different environment, and competitively why it is that we're building something that has greater long-term value for investors than other places they can put their money. And I feel like that's something that I can do successfully, and so we're committed to doing it.
I have a couple of follow-ups from that, and we had the cash flow statement up there a little while ago, and that brings to mind just kind of capital allocation priorities for you. One thing we haven't seen there, and obviously you mentioned you're a new company, you're in a regulated industry, just made a very large acquisition, so I haven't seen any share repurchases there. as you mentioned, you don't take much investment risk, right? And so just kind of give us your kind of priorities as CEO on how you think about capital allocation and the duties there going forward.
Yeah, so the first thing is just supporting our growth, right? We have been organically growing at about 20% since we became public, right? So, it is a capital intensive business. And so, we have a buyback in place, but we haven't exercised the buyback. Our stock price is down, but, if you want to do this on a mathematical basis, it's a marginal place for us to use capital. We're not sort of at the point where we would think about a dividend. We recognize that probably cuts us off from some portion of the investing population. Largely because we do believe that we can use capital to support our growth. That said, and obviously we just went through a transaction where we issued equity, but of course we issued equity to the right part of the population on the other side, right? It's not to strategic and employees. What I will say is that the capital light model of Apollo opens up a lot of interesting possibilities for us as a company about moving some of our earnings, not changing our business, but moving some of our earnings from underwriting income and investment income to fee-based income. And if we pursue some of that, that's going to liberate some capital needs. And in liberating some capital needs, that actually opens up the door. And we are certainly thinking about that. We're sitting at a level right now of value where we're kind of right at the margin of where buybacks really make sense. And so if we continue to sort of do the things we do and we're not getting rewarded, we're going to pay attention to that, and we now have a lever to go get at that. But we also have plenty of organic growth in front of us that I feel is the first place that we want to put all of our capital growth to work. Put it behind us. We believe in ourselves, and that's a sensible thing, I think, to do.
Yep.
Great. We're going to go to Anna, and then we're going to go to some lightning round final questions. And thank you for giving us an hour of your life. Anna, to you, and then we go our way.
Yeah, I have another question. I was wondering, with the growth and the adoption of AI in such a highly regulated field, how do you manage all the risks in terms of making mistakes, especially even just related to AI adoption, hallucinations, errors, all those sort of things?
So first off, I think it's important to know that much of what we do, we write on what's called a surplus lines basis, which gives us full freedom of rate and form, right? So think about the insurance contract can be tailored, it can be bespoke to the risk. We have a lot more flexibility as opposed to maybe personal lines insurance, buying auto coverage as an example. Look, I think very little of what we can even conceive of doing would be about redlining risks or things that could translate into the kind of things that you think could go wrong from a consumer perspective. I think much of what we're using AI for is how is it that we can have a product or a solution meet the risk, right? And because we're in the sort of complex specialty commercial end of the market, a lot of what we're doing is quite bespoke. And so, I think that AI gives us a better opportunity to figure out a solution, which is exactly what the insurance industry should be doing. A great example of this, I'll give you a really good one that just happened this week, right? So we write in the area of healthcare professional liability, and with what's going on in the current government, there's a lot of changes happening in healthcare, and a great example is that lots of military bases is one area of government. They're moving to private medicine coming onto the base, and with that, there's specific exposures to federal laws. It's a very complex area. That's an area where we actually did use AI to help us create a solution, products around when private healthcare practitioners are going onto bases and they're subjected to FCTA regulations and so forth, that we were able to create product around that. That's exactly what our industry should be doing. And so I think that I can see AI doing harm. I'd like to think that what we are doing is it's for the greater good, right? Our business is trying to find solutions that are products that are valuable to our customers to transfer risk and for us to earn an acceptable return on capital. And a lot of that is sort of on the innovation end, and regulators should be encouraging companies like us, not getting in the way. And today, we don't really see the regulators. It's a state-regulated system. We don't see the regulators focused on our part of the insurance market. I think they do have bigger issues. If you're in California, you better figure out how wildfire exposure is going to be addressed with an insurance product. That feels like a bigger issue for the industry than trying to regulate a company like ours.
Andrew, are you seeing more admitted players coming into the E&S market than before? How's that dynamic shifting?
I think because the E&S is, I used to say business is going to flow into the non-admitted surplus lines market and then flow back into the admitted market. Don't believe that. I believe it's a structural shift. I think it's a structural shift for a whole bunch of logical reasons, including that risk is getting more complex. And I think that what we're seeing is just more companies in general, admitted, new companies across the board. There's just greater participation. And in commercial insurance, our part of the world, in the U.S., 25% of all business is now written in surplus lines. Freedom of rate and form, freedom. You basically have a great deal more freedom. It was half of that only, I think, 10 or 15 years ago. So a doubling of the market share of surplus lines as opposed to admitted risk. I think that's a structural change that's not going to reverse. And of course, it's drawn in, more players, more numbers of players into the market as a result.
Andrew, Skyward's a relative baby in the public markets, right? We talked about 2023 IPO. And one of the things that we ask ourselves as investors and analysts here is when they grow up, who do we think they could become? So I'll ask you, as you look at it, the players, you've been in the business for 30 years, who do you think, as we look down the road, and we're long-term investors here, so we're not like in and out types of people. We hold companies for decades. If you look ahead a decade or two, what are some of the companies that you aspire to be like?
That's a really good question. Look, while very far away from where we compete, I think Progressive is one of the most interesting companies in our industry, and a company that is hugely valuable, operating at scale, and maybe one of the smartest data-centric organizations, that you'll find in financial services. So, I'd like to think that as we grow up, we see sort of our sophistication and standing, kind of similar. But I think that, I think that we're sort of carving our own way in terms of identity and how people feel about us as a company. I mean, one of the things we haven't talked about is culture and people and talent, and we are unique and extraordinary in that regard. And, when I'm done, I think that we will have an organization whose sort of identity lasts far outside of me or other executive leaders. It's unique and it's our own. And I think it's not understood by people, but that dimension, to be recognized as one of those companies that really is an outstanding organization for its people, its talent, and unique in terms of its orientation that way, particularly in light of some of the things that, it was only a couple of years ago where, ripe avocados in the lunchroom, at tech company X was everywhere. And now you're talking about downsizing, right? That feels like I'd like to think that we're a different kind of company as we go through these cycles, and that how people see us and identify who we are as being kind of one-on-one on this dimension. And I think it is really, in the end, all this other stuff we've talked about is really important, but our people are the reason that we're winning every day. It's a really unique place. I'm very proud of it.
Yeah, and that's
awesome.
true.
That's
and I say from the outside, it's hard to assess that culture. We do the best we can. There's lots of ways, and Anna and her team do that, certainly using artificial intelligence. But I see really high satisfaction scores for employees at Skyward and all that kind of stuff. And when it comes down to it, technology is available to everybody, but it's the people that make the place special and make all that stuff work well. And certainly I know we've seen a lot of positive scores for Skyward on that.
Thank you. I appreciate that because it's true. And what you see in the public domain reflects who we are.
Andrew, just one quick follow-up on the Apollo relationship. While so much of their business is U.S. tied, does the tie into Lloyd's does it offer up international opportunities now? Or
it does. It does.
How do you see that going forward, international versus U.S.? You mentioned the U.S. competitive market.
Yeah, a great example just right now is we're an insurer of liability coverage to the life sciences industry, and today we actually don't have the facility to be able to write companies with international exposure that needs to be covered through international policies. And so that reduces the addressable market for us quite considerably. Even before we close, we're already working on this specific area. And so that's like one little thing that's happening right now that massively changes. Even just these are U.S. domiciled companies with international exposure whose international exposure actually requires local coverage and thus local policy. And so that one item alone is a good window into things that can develop off the back of our combination.
What a great conversation this has been. I've learned so much. Thank you so much, Andrew. I'm going to ask you 3 rapid-fire questions. You can answer them as succinctly as you'd like to. What is one thing that is unique and special about your unique and special company culture?
One thing that's unique and special about unique, let's see, probably the most interesting thing is how we empower our employees to establish employee resource groups. We're very serious about them. We oftentimes have actually shaped what we do as a company around things that are coming up from those teams, those groups. And we're unabashed around this, at a time when, things might be feeling very difficult, sort of socially. We are really investing in our folks to do those things. And we have one simple requirement. They need to meet a certain number of people who have to have that interest, and it has to be able to be valuable to our company and valuable to that community, and we put money behind them. We let them do things that really allow them to sort of take that area of interest, that community, and develop it. And that has been hugely impactful for our company. Hugely impactful. It shapes so many things that we've done.
We're probably going to check in with your culture team because we have ERGs as well, and we can learn from you. Thank you for sharing that. Number 2, what's a company in specialty insurance or insurance, maybe even a smaller one, that you particularly admire?
There's a bunch that I admire. I think that probably 2 that stand out for us are both smaller specialty companies. One is a company called RLI. We especially are impressed by, they are also a great culture, very different than ours, but really have built a unique and very great culture. But the most important thing they've done is they've been immensely conservative in their financial management of their business. And ultimately, insurance, you don't know the cost of goods sold until some point in the future. And the way that they've built their rhythm of reserving for future losses very conservatively, and then recognizing that as that seasons, has been a mantra that we've tried to grow up into in a short period of time. And so we really see that as kind of a financial management dimension that we love. I think Kinsale is a world-class company and is valued as a world-class company as well. They were high up on your list, so we have a great deal of respect. They actually built a position in the market with a very unique approach, and so we look at a company like that we compete against. We're certainly oftentimes compared to, who's valued at a far higher set of multiples than us, and we like the fact that it creates a little bit of an umbrella for us to grow into, and I think that they're a really great company. So those are 2 that we hold out.
Very helpful, thank you. And finally, if we had an opportunity to talk to your children, what would they say about their dad?
What would they say? Listen, I mean, I think that they would say to me that they would say to you that we've enabled them to do things that they recognize as adults. One's 30, one's 27. They both live in New York, and they're both successful professionals. They've gone through life in a way that has given them opportunities that probably others haven't had, and they've leaned on us at critical points for guidance and advice. And I'd like to think that they feel that they've spared themselves of some very bad things along the way. And I think that when they look at many of the other peers, some who are burdened with financial burden, some who have made choices that they probably would have avoided, with mine and my wife's counsel, I think they'd say that's had a huge impact on their good fortunes in their life.
That sounds
thank
like
you
the
so much.
person we want leading an insurance company, right? Responsible person.
Exactly
with
right.
good guidance.
That's
Thank you for
exactly
that.
right. It's funny. I've never asked anyone that question before, so thank you for answering it. And I realized, not being a parent myself, what a tough moment it is, because your kids might watch that interview.
They're gonna watch. They're gonna watch this because I'm gonna tell them to watch this. So it's been fascinating. So.
Andrew, thank you so much for the time. I'm so thankful to Anna and our AI Llama team that created the systems that allowed me to find the company, and others had found it as well at the Motley Fool. And we've got a couple live recommendations, and as Buck said, we are inclined to hold for at least 5 years, and our greatest holdings are 10, 15, 20 years across the Motley Fool. We've been in business for 31 years, so we're looking very forward to being a long-term share owner of your business and following right along with you. And thanks for spending some time with Fools.
Yeah, thank you for having me. This has been terrific, and I've really enjoyed it. So thank you.